Thank you. Great to be here today. Just let's dive in as we have 10 minutes. So I think looking at the investment volume last year, so what happened? To be honest, not much. We haven't seen a lot of transaction. It recorded just over 4 billion baht worth of transaction. That's a 64% decline from 2022 levels. But if you look regionally, Thailand is not alone. APAC dropped around 16%. Overall, globally, volume dropped around 32%. In 2024, this year, we're expecting around 9 billion baht worth of transaction across Thailand. This only includes existing hotel, both leasehold and freehold. In terms of location, I think Bangkok historically has always been number one. However, this year it got overtook by actually Hua Hin by one deal, which we'll talk about later. Hua Hin make up around 35% of the total volume, followed by Bangkok at around 33%, and Phuket on third at 13%. We actually didn't see any transactions, sadly, in Samui last year, so hopefully this year. Just to look at some example of the transaction we saw in 2023, Kun Paul was here and he talked about the IBIS portfolio. We're sitting here again talking about it again because Origin actually sold 40% of their stake to their existing Japanese partner, Tokyo Land. And also they bought 2 additional hotels, which is the Green Palace Hotel in Chiang Mai and Beehive Hotel in Phuket Town. 2 leasehold transactions we saw in Thailand is one, the leasehold renewal from Sentara Resort and State Railway of Thailand on the Sentara Resort and Villas in Hua Hin. Another one is by Narai Group. They bought a 20-year lease interest from a private landlord on a hotel called Mirama right at the MRT in Samyot near Chinatown. So that's going to be rebranded as a Labdi. Another resort, hotel, which is in Bangkok, acquired by MBK, which is the Ibis Thai Vieng Thai. It was closed on acquisition and was rebranded and reopened last December as a Trinity Trendy Hotel, which is MBK owned brand. Looking at why Thailand is still fairly attractive against sort of regional cities, we've mapped here the hotel yield spread over borrowing costs. You can see that against sort of other cities in Asia, including Hong Kong, Seoul in South Korea, Sydney, Australia, and Singapore, and 2 cities in Japan, which is Tokyo and Kyoto. You'll see that Bangkok, Samui, and Phuket relatively are quite healthy, where you still see a positive spread between sort of borrowing costs and hotel yields are being offered of up to close to sort of 200 basis points. That number goes up a little bit in Japan, closer to 300 basis points. So some key takeaways for 2023, we haven't seen a lot of changes. I think everything is sort of expected. We saw more vacant possession deals rather than encumbered deals where it was encumbered with a brand. So people actually like having no brand, so they can put their own brand in or they can sort of align with their preferred brand. If you look at the underlying lease land tenure for deals, you'll see that freehold made up last year was around 61%. Leasehold is actually 39. Usually it's a bit more than that on the freehold end. The freehold would be around 80 to 90%, but it was skewed by the Sentara Hua Hin lease extension because that was a 30-year lease and we NPV it. So that was sort of skewed. If you look at sort of the buyer's profile, you'll see that will remain as developers. Last year, developer made up around 60% and hotel operator and owner-operator 40%. We didn't see any participation from PE funds at all just because of the relatively higher yield requirement that they need with the seller expectation here. We also see that because now hotels are cash flow positive, people don't need to sell. They can hold on to their asset and wait for the right price and the right buyer. So looking forward, we believe that sort of this year we'll see domestic buyers dominating the market again. Some new buyers, including residential developers, the likes of Origin, listing their One Origin Vehicle. Pluksa, with their joint venture with CapitaLand, they did bought a hotel in Singapore recently as well as a partnership. and also SC Asset buying a hotel in Soi 29 and setting up sort of looking for more recurring incomes, not only just hotels, but they're also looking at warehousing, data center, and to a lesser extent, offices. Interest rate, I think we get this question a lot. This is also one of the reasons why the volume is so low globally. We see our house view is that interest rates has peaked. However, it sort of probably won't come down until the end of this year. The last point we would like to make before I pass on to Kunjab is, we see one asset class time and time again sort of beat all the changes in macroeconomic sort of conditions. Trophy assets, whether be it core Bangkok or beachfront resort market, will withstand all the pricing. They'll always be highly sought after by strategic investors. And I'll hand it over to Kunjab to talk about some supply and trends in hotel operator survey.
All right, thank you, Kunon. Moving on, some supply numbers from the three main markets that we have, Bangkok, Phuket, and Samui. Roughly, we have at the moment around 150,000 keys in Bangkok, with many more to come, like Jasper mentioned just now. Most of the supply that will be coming in will be in mid-scale and upscale segment. Similarly, Phuket, we're now at around 62,000 keys. And again, the ones that will be coming in is upscale and mid-scale. Same goes for Samui, relatively smaller market at around 14,000 keys. And then you have 52% coming from the upscale segment. So more supply coming in. Just moving on in terms of the regional recovery trend that we have seen. On the left there, you see the number of year-to-date, November 2022. And on the right is year-to-date, November 2023. So it's very clear that we have recovered quite well in a year compared to what we had in 2022, where things are not really normal and only a few markets are actually open. Last year, I could probably say that we're back to probably the first year that we're back to the normal market where borders are more open. Only in Shanghai and Beijing is not back to the pre-COVID RevPAR level due to airlift challenges, but they're depending a lot on the domestic tourism, as you've listened to just now. Just want to touch on what we had survey last year from what we call Hotel Operator Sentiment Survey 2023. That is actually an entire report from what we've done in 2023, asking hotel operators what they think about the future. So you can look that up on our website. But I'll just mention some key findings that I find interesting from that report. One of the questions we asked them was that, what do you expect with the GOP level in 2024 compared to 2019? And 67% actually mentioned that they expect better GOP compared to 2019. Largely, this is because of the efficiency of operation that they have actually learned to adapt, and as well as the higher rate that they can expect despite occupancy not being back to normal. And we also asked them about the labor cost. The question was, how much would you expect your total labor cost to increase in 2024 compared to 2023? So a year-on-year increase. In general, they said, 47% actually said it should increase 10 to 20% compared to last year, repeating, the key point that we have known for a while now, that labor cost will be an issue for hotel operation going forward. The other point that I just want to mention is on ESG, right? The question we asked them was on the top 3 challenges that they face achieving environmental goals in your hotel. Number one reason that came up was actually in terms of the capital that actually has been provided to serve that goal, right? So limited capital of funds to tackle ESG goal has become the main problem for the operator. Number 2 is the lack of consistent and validated data or report that they can actually follow. And lastly, they're not sure what technology to use to adapt to that. And ESG has become more and more important every day, as you might have lesson in the market, and probably people will talk about it today. So we have to spend more time on ESG going forward. I have 2 seconds left, but this is basically the summary of the market that we have covered already. Airlift would be an issue going forward. We still look forward for airlift to be recovered to the pre-COVID level. Visa exemptions from the government has been trying to boost the tourism market. Will finally be in effect. We will see it more in effect and become more effective this year. Since last year, some were issued later than the others. In terms of supply, we'll see more upscale and luxury supply coming in as well in the 3 main markets that we have. Labor costs, workforce shortage will continue to be an issue in 2024, largely in the mid-management level where skilled labor are harder to find. And you're competing in Bangkok, Phuket, and all the major destinations as well. It's not like the rank and file staff that is easier to find. ADR will continue to remain strong this year, similar to last year, with occupancy likely to recover gradually to become in pre-COVID level. GOP will continue to improve as we've seen and we have interviewed many operators. A lot of them have adapted to the new way of operation already that is a bit more efficient. And lastly, investors, operators, developers are looking at ESG at not just a value added, but also sometimes they look at it as a criteria for investment. So we have to spend more time and capital investing in meeting the ESG goals as well. So yeah, that's a quick wrap up of the market from us, JLL. Thank you.
Thank you.